You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing.
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. Today's guest has a book out called $1 Billion Portfolio, and when I saw that title, I was like, yes, please. Brent Sprenkle has worked as a commercial real estate broker and an investor in Los Angeles for two of the nation's top firms, Berkadia and Sperry Van Ness, and he specializes in apartment sales. He's got more than 20 years of experience and expertise in assessing his clients' real estate portfolios, managing his own portfolio. With more than 350 apartment buildings sold, his sales of commercial properties have exceeded $1.2 billion. Hey, Brent.
Hello, how are you?
I'm doing great. So let's get right into it. Because I think, one of the things I thought was great in the book about $1 Billion Portfolio was this idea of mindset. And usually I'm like, mindset, because it sounds kind of fluffy. But in the book, you had this really good example of how you didn't have a $1 billion portfolio mindset in 2020 during the pandemic. You owned an apartment building. Something interesting happened. So can you share that story with us?
I think all of us have the unfortunate tendency to panic at difficult times in our lives. When COVID hit in March, you remember the stock market literally just dropping in half. We also had major issues with buildings that we owned. A building I bought maybe 5 years ago, it was one of these low rent buildings, and I got lucky with completely repositioning the property and pretty much doubling the value of the building within about a 12, 18-month period. But my property manager, as well as my lender, kind of convinced me to keep it and refinance the building and pull some money out and move on to another deal. So instead of just cashing out on what would have been an amazing short-term gain and doing an exchange and buying a larger deal, I went the easy route and just held on to it, refinanced, kept it. And what happened during the recession, we had the entire property rented out to an Airbnb operator. They were basically running the property as a hotel. They rented the units from me at above market, and then they went right back and rented them out as a hotel room. And when the pandemic hit, not a lot of travel. And they just basically mailed the keys back. Didn't even give me notice, just said, we're done. And that kind of hurt. Because remember, I now had a much larger loan on the property. And you tend to kind of panic when you're like, oh my gosh, now what do? I have a vacant building. Yes, there was money in the bank. There were reserves. We could weather the storm, but it didn't feel good. So the mindset really was knowing that, just like the stock market, it goes down and it will come back. These are good companies. Their stock doesn't go to zero. This was good real estate. It doesn't drop to zero. Yes, it might go from being worth X to 90% of X, but it's going to eventually come back to what it was and maybe even drastically more. So the mindset that I had to force myself to have was, this is a short-term thing. This is a pandemic. This wasn't caused because there was an earthquake and it's going to take years to rebuild. This was caused because people lost their jobs. Tourism is gone, and it's going to come back. So mindset is very critical to get you through these very difficult times that happen, but also not being over-leveraged in this game is very critical. And on that property, despite me refinancing, I wasn't over-leveraged. So it wasn't a horrible situation to have to keep a building vacant for 3 months.
Interesting. I like what you said there too about short-term thinking versus long-term thinking. I think that what happens so much is, a property loses value, people panic, they sell, they forget that these markets are cyclical, and what goes down is probably going to come back up. Los Angeles especially isn't going to lose its value over time.
Herd mentality. I mean, look at the stock market. It doesn't go down a little bit. It just crashes because everyone's just pulling their money out. So you have to try to not pay attention to the masses, not follow the herd. And I think as humans, back to our hunter-gatherer origins, we're just used to, there's a fire, everyone run. And we're used to we're biologically trained to react that way to horrible situations. And that's kind of what separates the really good investors from the amateurs. And I still think that I've got a long way to go, and all of us do. But those are hopefully once in a generation things, like COVID, and I'm hoping we don't have to live through another one of them again. Although if there's always a new surprise on the horizon that we don't see. No one saw that coming. No one saw 9/11. No one saw subprime. I mean, these are just things that happen.
Yeah, absolutely. So I want to go into some of the things you talked about in the book. So you just mentioned being a hunter-gatherer in real estate, and there were a couple of strategies you had in the book that I thought were pretty interesting. So one of them was the bargain hunter, and the bargain hunter buys any property anywhere as long as it pencils out. That felt really risky to me, but it sounds like it works for some people.
So remember, most, if not all of these strategies are from clients of mine that have built these billion-dollar portfolios. And that is what some clients of mine do. They know that apartment buildings in a certain area sell for $200,000 a unit. So they see something at $150, they jump on it. They see shopping centers that they know sell for $300 a square foot, and they see one at $200. They jump on it. They're buying an arbitrage. They're just saying, this usually is worth X, and I see one at Y. It's not going to go lower in value. It's already probably at rock bottom. I'm going to buy this property, try to improve it, and get it up to where it should be, and either sell the property at a nice profit or keep it, refinance it, and just throw it under management. So that is a strategy. There's obviously downside risks to that. Properties that are cheap in comparison with others are for a reason. It's mismanaged. It's in a challenging area. There's issues with the property. So you have to really, really, really be an expert on that particular property and that particular submarket to buy in that business plan. If not, you could just get crushed, especially if it's out of town, out of state especially. So many people make that mistake. They're buying in 3,000 miles away from where they live in an area that their friends have bought and say great things, but they have no idea what they're doing. They go to that market, someone says it's a good deal, they buy it, and they wind up later regretting it. But as long as they are not over leveraged, they're going to hold on and hopefully do okay. But again, buying with this strategy is a little bit risky for that reason, that there's a reason why the properties are cheaper than others. And you have to be very careful.
Yeah, absolutely. Another strategy you mentioned was the cluster strategy. I think this one is one a lot of people do. You kind of get comfortable with a neighborhood or a sector and you just kind of stay there. My concern with that is then you're kind of, it's a little bit of a lack of diversification. Is that something that you feel like is, it seems like a lower risk strategy, but does it end up being higher risk in the long term?
So this is a strategy that Bob Hart from True America shared with me, and he's by far one of the most successful real estate investors in the country. And his idea was that, and they're based out of West Los Angeles, if they're going to fly to, say, Florida, they're not just going to buy one building there. They're going to buy 4 or 5 buildings so they have an economy of scale. They fly into town, they go see the 4 or 5 buildings, they meet with the managers, maybe they go look around at some other deals are for sale, they jump back in a plane, they're home the same day. So that was his strategy. But yes, if you're buying a ton of one particular property in one particular area, you have the downside risk of recessions, political risk, economic risk. I mean, this is Los Angeles. There could be an earthquake, and then you're sitting there going, now what? Rent control. Look at all the people that owned apartment buildings in New York City, and they passed insane rent control laws a few years ago. Those properties dropped like 40% overnight, and they're not yet back. So yes, there is definitely economic risk and political risk buying too much of one product type in one particular area. That's the issue with clustering. Yes, it's very efficient, it's very logical, but you just have to be careful about where you're doing it. And you have to make sure that you're buying in an area where there's going to be appreciation, rents are growing, population, job growth, all the logical things that we all know about. But this is why people buy different product type all over the country, to have that diversification. but maybe pick 2 or 3 different product types, or one product type in 2 or 3 different areas. A lot easier than picking 3 or 4 different product types in 10 different areas. Hard to get that economy of scale for that clustering, and you're spreading yourself too thin.
Yeah, I think that's a really good point, because I feel like for investors, a lot of times you want to keep track of what's happening in that particular area. So, learning what's happening at neighborhood councils, what's happening with zoning, all of that. It's a lot to manage if you're looking at a bunch of different areas.
It's a bit overwhelming, but this is why people set up corporations and they get different asset managers and different people assign different tasks. It just depends on your level of scale and what you're looking to do and how much money you have to play with.
Well, let's talk a little bit about cap rates, because I feel like that's something for beginning investors. They keep hearing the phrase cap rate. They don't exactly know what it means. They don't know what the target cap rate they should be looking for. How do you sort of talk to your clients and to other investors about kind of the basics of understanding cap rates?
Well, cap rate is the essential economic indicator in commercial real estate. It just purely tells you what your yield is going to be if you buy something all cash. You buy $1 million property at a 5 cap, no loan, you're just paying $1 million for it cash. You're getting a 5% return if it's a 5 cap. It's just the unlevered return. Now, there's a difference between buying a 5 cap with no upside and a 5 cap with upside. With upside, which is what everyone's looking for, you've got somewhere to grow. You feel comfortable that you're going to grow the rents. When there's no upside, you've got to be buying that property at a really great cap rate. And you have to just hope that that area that you're buying in and that just the property to begin with is going to have the ability for rents to grow up. We just had a client that bought a building in San Diego, an apartment building. It had no upside. The owner completely maxed out the rents. But the buyer knew that this was an area that was having really great rent growth to the tune of about 8% a year. So he knew if he bought this property, even at a 5 cap with no upside, he was going to be able to grow the rents at probably a 5.5 cap within a year, which is just amazing. And all the other buyers were like, this thing's tapped out. What am I going to do with it? Now, if you're buying a building at a 5 cap in an area where there's no rent growth, at least it's a good cap rate going in, but we see oftentimes the mistake that people make is not focusing on the healthy combination of current cap rate versus potential cap rate. There's got to be an opportunity for you to add value to the property, because if you can't, you're selling it for no better than what you're buying it for. If you're buying a property at a 4.5 cap and you think you can make the property a 5.5 cap through some relatively simple rent increases, then you're going to do great long term. You can sell it at a profit, refinance, pull some cash out, and move on to the next property. And that's really kind of the dream of real estate, is buying a property and being able to go back to the well and refinance it every few years, pull a little bit of cash out in a healthy manner, and use those proceeds to go buy the next deal. That's the dream, right? If you're buying a property and you can never raise the rents, I see these big box retails where there's zero rent escalations, and I don't quite get those, but it's a safe haven, I think, for the right groups. You're not going to be able to reposition and sell that thing at a profit anytime soon, but if you're looking for yield and it's like a coupon clipper, then I guess that's where you go. But there's a healthy medium between what the current cap rate is, what the market cap rate is. I'd rather buy a 4.5 cap if I thought I could get it to a 5.5 cap than buy a 5 cap with no upside. Because at least I know I've got a fighting chance at the 4.5 cap of being able to reposition it and increase the value.
Well, I think that also ties into that $1 billion portfolio mindset too. I think a lot of people get hung up on the one property in the one moment. And what you're really encouraging here is, chess, not checkers, long-term thinking about refinancing, what you're going to get, how it's all going to play out, and how this one decision then sets you up for the next one, which I think is what a lot of people get. They can't quite get from 1, 2, 3 properties to that larger sort of, having a real portfolio. It's
a different mindset. And I put this also in a book. We have a lot of clients own 1, 2, or 3 buildings. Now we have clients own 20, 30, 40, 50. There's rarely people that have like 5 or 6 buildings. It's they either have a couple or they have like ridiculous portfolio. And it's their mindset. When you get to meet the people and you talk to them, like they bought 1 or 2 or 3 and it became challenging. It became too much management and it just became overwhelming. And they're like, no more. The people that kept buying were the people that they liked it. They bought the building, they added some value, they turned it over to management, they bought a next building, fix it up, turn it over to management. It was kind of a game for them. It was, it was like Monopoly. They just enjoyed it, and they saw the path. They saw that within a very short period of time, I can go from 1 building to 5, then I can go from 5 to 15, I can go from 15 to 40, and they see how they can scale the business. And at some point, they start bringing investors in, and it just explodes from there. So that's really the mindset of the people that have these massive portfolios. Everyone starts out with like a little building for the most part, and then they buy a bigger building. And it's incredible that it doesn't take long for this to snowball. But of course, there's economic issues in the middle. There's a recession. There's other things that happen, health issues, family issues. And you just have to get through that. But the people that enjoy it and find it to be fulfilling, kind of a mental challenging, like a game for them almost to say, those are the people that thrive and have huge portfolios. They just enjoy it. They enjoy the thrill of the next property they're going to buy. They get a kick out of that. It's like a rush for them. It's like a great golf shot. Like, wow, I did that. I pulled it off. Amazing. It's just a feeling that they get. And it's when you talk to people after they bought deals, they have these great stories and they brag about it, and they feel really great about it. People don't really talk as much about selling properties. They seem to like buying it more than selling.
I would agree with that from a stock and real estate investing perspective. I love that the process of the research. Do I like this company? Do I like the management? Like, I get very into that part, but the when I have to sell it part, I have to sell it. That's not the romance. The romance is in the considering whether or not that property or that investment is right for you. That's the fun part for me, at least.
There's no pride of ownership with stocks. It's like,
yeah, there's still a little pride of ownership with stocks.
I mean, you buy a stock for $10, you sell it for 15, you feel pretty good. But, the people that buy real estate, they're oftentimes going to keep it for 5, 10, 20 years, generational, who knows? So it's the acquisition that really gets these people excited. Like, wow, I just bought an amazing deal. I feel I can do really well with it long term. I got a great loan on it. That's a real sensation. Sure, there's people are like, I bought a deal for $1 million and sold a year later for like 1.6 and pulled out 450,000 net. Yeah, that's a big rush, but more it's the people that get excited that they just closed on a great purchase. And that's a feeling that would be great to have more often than not, that after a while you run out of money.
Good point. So another thing that you said in the book that I thought was really interesting is you don't look at the history of what a property sold for. And I think that is fascinating because I think everyone, if you're buying a house, if you're buying an investment, everybody looks, especially now with things like Zillow, everybody looks, okay, they bought it for this, then, and they get all wound up in that. So it kind of reminds me of that idea of, not looking backward because that's not where you're going. So you obviously think this is a bad idea. Why is it such a bad idea?
If you're looking to buy a building for, let's just say, $5 million, and the prior owner bought it for $1 million, and you're negotiating over 25 or 50 grand, oftentimes you're like, this guy's just a greedy pig. He bought this thing for $1 million and he's being greedy over 40 grand. And that's just not a good mindset to have. It's, who cares what he paid for it or she paid for it? It's irrelevant. So that's the first thing, is you want to keep kind of the greed aspect out about the seller's profit. The second thing is how irrelevant it is. What if the property, when the person bought it for $1 million, was burned down? What if it just had an earthquake? What if it was 50 years ago? What if there's another story behind it? It's kind of irrelevant to what it's worth now. And the second thing is just like stocks. I mean, look at what Amazon stock was a bit ago. Look what Bitcoin was not that long ago. I mean, it's like, sure, real estate has a real value, and Bitcoin, no offense to those who invest in it, who knows what it's really worth, like Tesla stock. I mean, sky's the limit, right? But if a property is worth $1 million and it goes to $2 million, it goes to $3 million, as long as it's going up for logical reasons, the rents are going up along with it, and the net income is going up, and you see a path that's going to continue, then that property could double in value every 5 to 10 years. And you know what that does to your net worth and the cash you can pull out on a refinance or a sale. So oftentimes if you see a building was worth $1 million 10 years ago, now it's worth $4 million, well, there's a good chance it could be worth $8 million in another 5 years. So maybe that's a good thing. But it can lead people to think, oh my God, I'm overpaying for this property because this thing was worth a third of this not that long ago. So you need to look at what it's worth today in comparison to other properties are for sale, what other properties have recently sold for. And you need to think to yourself, how can I reposition this property to take it from $3 million to $5 million And then if I sell it at 5 million, how can I go buy a property for 8 million and get it to 12? That's the $1 billion mindset.
All right, I love that. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material, and it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. All right, I am back with Brent Sprenkle, and we are talking about how to build your $1 billion portfolio. So before the break, you mentioned something, you mentioned greed, and this came up in your book a lot, and I thought it was really interesting. You talk about managing your greed, and I feel right now people are so focused on highest value for the property, really, it's hard to not let your greed get out of control because it's part of your excitement, but why do you need to manage your own greed?
You'll never be able to transact if you're constantly focused on getting the last dollar. And a client of mine, Andrew Tavicoli, taught me that expression, manage your greed. And I was always fascinated with it because at first when he told me that, I was kind of like offended, like, you calling me greedy? It's kind of like an offensive term, right? And he was like, no, hold on. Greed is when you buy a building for $5 million and 3 years later it's worth 10. And you have an offer for 10 million, and you're like, nah, I'm going to keep it because I think I can make it worth 11 million in 6 months. That's being greedy. And I said, well, Andrew, how do you stop that? He said, you need to have a business plan. It's like, especially if you're buying property with investors, you need to say, we're buying this property for 5 million. We're going to sell the property when we can get the value to between 8 and 9 million net. And here's how we're going to do it. And here's approximately how long it's going to take and how much we're going to have to spend on it. And if you get the property from 5 million to 8 million in 3, 4, 5 years, everyone's thrilled. If you get to 10, it's everyone's jumping up and down, and you're probably getting a bonus if you're the one to put that deal together. But if you get the property from 5 million to 10 and you don't sell it, well, what if it drops down to 6 the next time there's a recession? Then you're really kicking yourself. You could have cashed out and moved on to the next deal. Because for you to take a property from 5 million to 8 million, you probably squeeze most of that juice out of that lemon. There's not much upside left. So you need to sell it and move on. Now, if you own a property yourself, like that little building I had in Hollywood that I did the Airbnb thing on, no one's going to be mad at you if the property goes from 1 million to 2 million and drops back down to 1 to 3 if there's a recession. But if you buy into a building with investors, you have to make sure everyone's core business strategy is in writing about what you're buying a property for, what you're going to sell it for. So you're managing everyone's expectations, which is the same as what their greed level is going to be. And they know what the plan is. Managing your greed is just your way of making sure that you execute on what you do. It's no different from what people do with their stockbrokers. They tell them, we're going to buy this stock for $10. When it gets to 13, sell it. There's no emotion. It's automatic. They just do it. Goes into an algorithm in their computer. They don't even have to push a button. But with real estate, the tendency is to say, I can keep doing something. There's another unit that has rent below market. I can add another amenity. There's a rent renewal coming up. It just never ends. And you're just going to, and those are the little things that don't affect the value that much. Maybe they take it from 10 million to 10.1 million to 10.2 million, but they're a lot of work and you don't gain that much from it. You're better off selling and moving on to the next deal. That's how you build your $1 billion portfolio.
Well, that relates to another concept that you talk about in the book that I really liked and I thought was a little bit different than what I've heard from other people, which is the idea of leaving meat on the bone for the next buyer, which is sort of like when you have that rent renewal, you don't renovate every single unit. You don't bring the building to absolute perfection. And I thought that was really interesting because a lot of owners, they want to make the building absolutely perfect because they feel like they can get the highest price. So this strategy is interesting to me. How does it work exactly?
Commercial real estate is different than buying a new car or a new house. On a new car, you're expecting perfection. New house, same thing. Everybody wants to add value on a commercial real estate investment. They want to look at a property and go, you know what? If I paint the building, I bet I can get higher rent. If I landscape it, I bet I can get higher rent. If I make some cosmetic improvements to some units and I have vacancies, I bet I'll get a higher rent. They want to feel they're smarter than the previous owner. They want to say, you know what? That last guy was kind of lazy and I'm going to take advantage of that because I feel if I do X, Y, and Z, I can raise rents $150 a month on all these units. If you are the one that makes your building like a brand new car, you leave no room for the new owner to do anything. They're looking at it like, what am I going to possibly do with this property? They gutted every unit. They hired like a designer and it's a brand new building, but it's 60 years old. What am I going to possibly do? And what's going to happen in 2-3 years and all these cosmetic upgrades fade and the units aren't brand new and hip and the facade, that paint job, and the landscaping don't look as good anymore. It's going to be worth less. Everybody wants to feel they can add some value to a property to push rents higher. So you need to give them that dream, that meat on the bone, that they can do it. Sometimes if people are selling 100 unit, like a 100 unit apartment building, they'll do an amazing job on 70 units. They'll renovate the units and get high rents. And then they'll dangle that carrot in front of the buyer. Hey, there's 30 units we haven't touched. If you go in and renovate those 30 units, you can do much, much better. Reality is, those 30 other units, it's going to be a lot of money to renovate those things. It's time. That's why people do 2/3 of the work. They leave some meat on the bone. They sell the property. Everybody's happy. Buyers need to feel like they have an opportunity and they're getting a quote-unquote good deal for you to have a happy transaction.
That makes sense. Well, let's talk a little bit about renovation because there's a lot of that you discuss in the book about the unseen things, fixing roofs, fixing, plumbing, electrical, that kind of stuff versus fixing the cosmetic, the aesthetic things, replacing countertops and, doing paint and landscaping. So how do you decide which of those things to do first?
Everyone has a different business strategy. A client of mine, Abe Stein, he does all the mechanicals immediately. If the roof is somewhat older, he'll put a brand new roof on it. If the plumbing looks suspect, he'll just replumb the building. He just wants to get it over with because he knows it's faster and cheaper to do it all at once than to do it piecemeal. And everyone that's ever owned an apartment building knows once your plumbing's bad, you could spend $100,000 redoing the plumbing here and there, as opposed to just spending $40,000 just gutting it all at once. So Abe's strategy is get it over with, it's cheaper, and then you can move on to other big picture things. Now I have other clients, they buy buildings, they do nothing to mechanical, they just make the building look as pretty as they can, and that's what we call putting lipstick on a pig. Might not be the nicest expression, but from the outside it looks great. paint, aesthetics, landscaping. They take half the units and they make them amazing. They get high rents, and then they sell it. And the buyer comes in like, whoa, we got plumbing issues, we got roof issues, we got other problems. Maybe there's a small credit, but the guy's selling the property. Abe's strategy is he's buying the building to keep it for a long time, so he wants to make sure everything's great. The other guys, and I won't name names, they're buying the building to churn and burn it. You have to be really careful about who you're buying from. If you're buying a property from somebody who you find out, it's what they do for a living. They're flippers of commercial real estate. You probably know that they probably haven't done much on the mechanicals, because you don't get, if you spend $100,000 redoing the plumbing, a buyer's not going to pay you an extra $100,000 for it. They expect the plumbing to be great. They're not going to pay you $30,000 because you just spent $30,000 on a new roof. They expect the roof to be good. So these are long-term items that you're doing to save money for yourself over the course of 10 years. If you're buying a building to get out of it in a year or two, you're probably just going to fix the glaring items, which is the leaky sewer line, the fact there's low water pressure in a couple of units, the fact that half the windows don't operate and some of the ACs are dead, because you can't get good rents with those. You can't get good tenants and you can't get good rents. And that's the issue. There's certain people do absolutely nothing, but they know if there's no water pressure, they're going to have issues renting their units. So they take care of the essential items so they can lease the units, and then they can sell it for a profit and move on. The buyer will have to deal with those upgrades later, but that's why people do inspections.
Good point. Well, and I think the other reason I like that strategy too is you mentioned earlier the kind of the newness aspect on renovations in individual units, or even changing the color of the building. That fades out pretty fast, whereas dealing with the deferred maintenance, first you get that stuff done. Those things, I think in general, a roof isn't gonna, once you replace the roof, you're not gonna need to do it next year. So it seems like if you're holding it for any length of time, that makes a lot of sense.
We're also having issues these days with insurance companies. Insurance companies want to make sure that all the major systems have been upgraded within 30 years. If you haven't touched plumbing or electrical or roof in a while, your insurance rate could be literally double what you'd like it to be. And if it goes from $5,000 to 10, you're blowing $5,000 with nothing to show for it every year. Over the course of 5 years, that's $25,000. That $25,000 would have gone a long way towards some good upgrades.
I think that's really smart. And that kind of reminds me of my favorite quote in the book, which was from Keith Wasserman about running your business like a Honda. I kind of like that analogy, because I think all of us know kind of, the Honda brand and that idea of cars that just kind of run forever. What does that analogy mean to you?
Lean and mean. What Keith was referring to is run the property as efficiently as you can. Don't spend money on things where you don't get a yield from it. Like painting the back of the building. No one ever goes there besides the utility person. Don't spend extra money on things that just you're not going to have anything to show for it. Over management, things of that nature. If you're running a Ritz-Carlton, sure, everything's got to be perfect. But you're running an industrial building, a shopping center, an apartment building, there's certain things you spend your money on, there's certain things that you don't. Run it like a Honda just means model of efficiency. You spend your money where you need to, you try to keep your expenses low, and you try to just maximize what you have and eliminate expenses that aren't going to get you anywhere. We're not talking about not taking care of deferred maintenance, but we're saying take care of what you have to in the most efficient manner. A lot of people say they're going to do that. They make the efforts, and then they just turn it over to management, and they don't think about it. And then 5 years later, they find out that the management company's been having trash taken out 5 times a week, or it could have been done twice, and they just blew $5,000 a year on extra trash removal. You just have to be very cognizant of all your overhead and where you're spending your money.
Well, that was another thing that you mentioned in the book that I thought was interesting was, and this is going to sound really cynical, but that idea that you're probably going to get taken at some point a little bit by some property manager, something, that there's probably something that's going to happen, and it's just sort of a fact of being in the game. It's
not necessarily the property management company, but it's a vendor, their employees, it's anybody. If people see an opportunity to take advantage of a situation, oftentimes they can't help themselves. Lots of people get their laundry money stolen by the person who's supposed to be taking it out. We've seen situations where People have just been flat out overbilled by a vendor who just pockets the money. That's the challenge. It's the little things. The big things people pay attention to. There's a $10,000 plumbing bill. They want to pay attention to it. But the $200 monthly recurring charge, people just don't even look at it. It could turn out that it's not really even happening. I had a situation myself where I was paying for cleaning. Supposedly there was a situation where there was trash building up in front of a property and we had to have someone come by 3 times a week to take the trash out. I went by it and there was trash everywhere. I was like, how am I paying 3 times a week for this? It turns out I was just getting robbed. The property manager was just taking advantage of that, knew I didn't ever go to the building, and let's just say I don't use him anymore. But you have to be careful with what is going on at your buildings. Was it Ronald Reagan said trust but verify or something like that? You have to do that. You have to be cognizant, but you have to check things out.
Absolutely. At The Motley Fool, we kind of know all of our stock investments aren't going to be winners. You mentioned in the book, the same thing happens in real estate. You know, there's good deals, there's bad deals, but there's also a lot of deals that are, they're in the middle. How do you bounce back from, the not great deal?
Well, the people that don't do well in real estate are the people that are just only focused on buying with leverage. And thank the Lord, we don't see much of that anymore. But 10, 15 years ago, back in the subprime days, people were getting 90-some% loans. Those are the people that just got wiped out. So you are going to buy something, it's going to happen, that's not going to do particularly well. You're going to go buy a building for $2 million and 3 years later it's worth $2 million or 1.8 or 1.9. So you really have 2 choices. See if you can do something to improve the value of the building or just get out of it. You have to take really an educated approach, talk to people, talk to real estate brokers, talk to property managers, and see what your options are. But if you don't think you can improve the value of a building, probably get out of it. That's what people do in the stock market. They buy a stock for $10. It goes down to $9. They think there's no chance of coming back. Well, guess what? They need a write-off for all the other stocks that did incredibly well. So sell that property. You don't even have to do an exchange. Take the money and go buy another deal. Some people refuse to sell at a loss. In my opinion, is foolish because that property might not ever do well. And then they're stuck with this dog for the rest of their life where they could reposition it by selling the property, take the money and buy another deal that might do amazingly well. They bought a property for $1 million, doesn't do well, they sell it for $900,000, but they go buy another building for $1 million and it's worth $3 million a couple years later. That's the person who's going to eventually have that $1 billion portfolio. That's the right mindset.
The sunk costs fallacy, that gets people all the time.
Not every deal is going to be amazing, especially if it's commercial properties. We've seen what's happened with retail. Not easy. Apartments, rents typically don't go down, stay down for long. Commercial's a different deal. Office, retail, shopping centers, those sometimes go down and don't come back up for a while. So that's where you really, really have to be careful with what you're buying.
Absolutely. All right. Last question for you. Obviously, you have these high-profile clients that have billion-dollar portfolios. What's the one personality trait you think is most likely to indicate success for anyone who kind of wants to replicate that and get their own billion-dollar portfolio?
They all have tenacity that's beyond even my ability to explain it. They just don't give up. They buy a deal and it doesn't work out, and they fix, like we just talked about. They sell it at a loss and move on to the next deal. They don't get caught up in the mistakes they made. They're just willing to keep trying and keep buying and keep looking and keep digging. They're aggressive, but not in the same way as oftentimes people think negatively about aggressive people. And I hate to use this expression, they're deal junkies. They just get a kick out of it. They get a kick out of finding the next deal, buying it. It's a rush to them. That is the type of person who winds up very successful in anything that they do. But lastly, most importantly, they enjoy it. If they don't enjoy looking at commercial real estate, talking to brokers, driving real estate, they should go find something else to do. If you didn't like playing Monopoly when you were a kid, this isn't for you, because this is a different version of Monopoly, right? You're spending real money. And I have a friend named Kenny who did incredibly well at commercial real estate, but then just got really exhausted with dealing with tenants, dealing with the city, just all sorts of headaches, and he's kind of working his way out of the business. He just never really had passion for it, but he saw that prices were really, really amazingly rock bottom low back in the 90s, and he took advantage of that. But the people that get into the business now, prices are not at an all-time low. They're at an all-time high. So these people must really feel passionate about wanting to be in this business and feel there's a way they can grow it and succeed and do well, which is a different mentality than the person who's getting into, I hate to say this again, Bitcoin and crypto, who expect to make a super quick buck. This is a long-term business. This is not an overnight deal. You're not going to get rich quick in real estate, but you're going to grow an amazing long-term business legacy for your family. There's a lot of amazing things about commercial real estate, but getting there is much longer and more painful, and cash is obviously key. Your ability to have the money to buy your next deal is so important. But I don't know if I properly answered your question. The one characteristic is definitely tenacity, but there's so many others that go into it. It's like asking the one characteristic of an amazing athlete. It's a lot of it is just various different things. I mean, everyone has their thing that makes them successful, but the people that just stick with it are the people that always do well.
Well, I think that's perfect. I think that's a great place to end things because, yeah, tenacity. Athletes, hey, look at someone like Chris Paul in the NBA playoffs. You know, took him 16 years to get there. Tenacity, it can be a beautiful thing. Yeah,
of course, they also probably really enjoyed playing basketball. So it's just like to do something 8 hours a day, you better enjoy it. I used to be an engineer and I hated it. I was like, I'm never going to be a successful engineer because I don't like what I'm doing. And I'm never going to be good at this and do well financially because I don't have any passion for this and I don't enjoy it. There's no challenge. The people that do well in commercial real estate are always looking for that next challenge. They get a rush out of finding the next deal. That to them is like opening up Christmas presents. It's just like, wow, what's in this box? What am I going to find? It's just a different mindset.
I love that. Well, thank you so much for your time. A reminder to listeners, book is $1 Billion Portfolio. Check it out. It's awesome. Remember, you can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.